Hi, I'm Hogan from Hong Kong. And recommend that you sell Heineken NV. Heineken NV is a Dutch company that brews and sells beer. It is the third largest brewer by volume in the world, operating in 6 segments. Over 50% of the company's sales are from Americas and Western Europe. The whole basic scenario considers fade and inconsistent asset growth, which results in an 80% downside. This contrasts with other equity researchers that predict a more optimistic target price. The implied market scenario also presents a higher expectation of CFROI and real asset growth levels. The reason for this is because management has been able to keep CFROI levels consistently above its discount rate. Aside from occasional disposals and sales, the company has reinvested its earnings to grow its assets through acquisitions. By acquiring companies when its CFROI levels are higher than its cost of capital, Heineken follows wealth creation principles and shareholders have responded positively. However, when we look into the three drivers model, we see that the level of positive CFROI levels is decreasing since 2012. Operating margins have been stable, but sales growth has been volatile with the shift to emerging markets through acquisitions. This has not worked with asset turns on a downward trend in the past 5 years and is the reason why decreasing CFROI levels since 2012. To prove my analysis, I further looked at the strategy of Heineken and how that impacts the three-driver model. Firstly, operating margins is at the median compared to its European beverage peers, but started falling behind in recent years. Secondly, asset turns have been historically below peers. The situation has worsened with a rejected acquisition by SAB Miller. Thirdly, the alcohol industry has seen changing consumer tastes in the 21st century. The beer market is expected to shrink amid a growing shift towards wine and spirits consumption. Finally, soft sales in emerging markets like APAC and Africa have not offset such a decline in European markets. Adding a CFRY peer comparison, we can see that Heineken is below average when compared to its peers. This is strong evidence of the underlying issues with Heineken. Other indicators also explain why Heineken is overvalued. The operational performance score and accounting quality shows Heineken behind the industry. Both PE and EV/EBITDA ratios track the industry mean over time. To summarize, I predict an 80% downside potential to the current price with a slow CFROI decline and further asset growth. At the same time, I anticipate sales growth and asset turns will decline and slowly return to the industry mean as we move forward. The valuation matrix validates the downside nature of this stock. In the short term, my analysis shows that Heineken's strategy has been fully executed properly to show benefits, but this has not been the case. Current market conditions and changing trends pose a challenge that makes Heineken stock a good sell proposition when the market overbuys. Thank you.